So should you sell all your stocks in a bear market, take the cash and hide it away somewhere? Well, that's what most people do instinctively, because as human beings, the moment we're threatened, we are fearful. What we do, that's why we run and we hide. And so most retail investors, the moment they find that the market drops to a certain point and they panic, they read all the negative news, what do? They sell and they take the cash and they hide it away, and they do not dare to get back into the market again for another many years. And that's the worst thing that you can ever do. Most retail investors, in fact, would sell really close to the bottom, because that's normally the time of maximum panic. And if you do that, I can tell you that 1, 2, 3 years from now, you're gonna really regret it. Take a look at this chart from Morningstar.com, which to me is the number one research website for stocks in the world, right? So this chart is from one of their presentations, and I found it really interesting. And this is based on the financial crisis. So during the financial crisis, assuming that you had, say, 100,000 in your account, and during the crisis, the market tanked and you're like panicking, oh my God, I'm gonna lose everything, right? And at that point, say at the 50% mark, when you lost half and you say, I can't take it anymore, and at that point, if you sold everything and you kept everything in cash, what would have happened? You would have gotten this green line, all right? Now, if you had sold everything and said, okay, you know what, I'm gonna get back in when the problems are over, when the crisis is over. Now, here's the problem. The moment the crisis is over, guess what? That's right, stocks will be at all-time highs again. Remember, stocks are only low when there's uncertainty. When there's certainty and there's confidence and everyone is buying stocks, that's when you get high prices. So if you had gone back in 1 year later, you'd have gotten this blue line over here. Now, what if you just stayed in the market and closed your eyes and just gritted your teeth, right? You can see that a couple of years later, you would have experienced this blue line. So you can see that by getting out of the market is the worst thing you can do for your long-term net worth or wealth, because you would have ended up from 100K, you would have ended up with only $55,000. Add inflation into that, it's going to be worth a lot less. Now, if you got out of the market and got back in 1 year later, a couple of years down the road, you would have grown your portfolio to 155,000. Okay, not bad, from 100 grand. But if you just stayed in the market, okay, you'd have ended up with $238,000. More than doubling your money from your initial investment, just staying in the markets. Now, are there times when it does make sense to sell your stocks in a recession or bear market? The answer is yes. So when should you sell stocks? A few instances. You should sell your stocks only if you're holding low quality or overvalued stocks. So what are low quality stocks? In other words, you're owning stocks of businesses that do not have consistent increase in sales, profits, and cash flow. Or these companies have high levels of debt, or they do not have a wide economic moat or sustainable competitive advantage. These lousy companies, you gotta sell. You gotta sell them. Why? Because if it's a long recession, they could go bust. They could go bankrupt. Okay? Whereas if you own great companies will only get stronger after a recession. Why? Because all their weak competitors are dead, or they may buy up their weak competitors. Okay? Now, if you were to sell the stocks of lousy companies or they're overvalued, don't just keep the cash under your mattress because it's not growing. So what I would do is, if I got lousy companies, I'll sell the lousy companies, take that cash and reinvest into high quality companies, leading companies in the markets. And those of you who have taken my course on value momentum investing will know that we only invest in companies that have got consistent increase in sales, profits, and cash flow, that are as recession-proof as possible. Companies that have a wide economic moat that protects them from competition. Companies that have got low and conservative debt. Why? Because these are the companies that are going to bounce back when the bull market comes. Remember, when a bull market comes, only good companies will recover. Lousy companies will drop and never come back. So you got to get rid of the lousy companies and reinvest in the good companies, right? Number two, you may have to sell stocks if you are over leveraged. What does that mean? It means that you have borrowed money to invest in the markets. Now, first of all, it's always very risky to borrow money to invest in the markets. But some people borrow too much money to invest in the markets where they say it can't go down. If it goes down, I can't pay it back. In those circumstances, you better sell your stocks and raise cash to pay back whoever you borrowed the money from, which is usually the bank. Because if you hold on and the market keeps going down and down and down and lasts for 1 or 2 years, you may get wiped out. So those are the times when you got to cut your losses and you got to run, right? So, never invest with borrowed money as far as possible, especially if you're over leveraged. Number 3, if you do want to sell your stocks to raise the cash or to reinvest in something else, something better, remember, do not ever sell at the lows of the market. Sell at the rally highs of the market. Remember, in a bear market, prices generally go down, but they don't go down in a straight line. Nothing goes down in a straight line all the way. What happens? That's right. After the drop, it will always rally up. There will always be a relief rally, and it normally will hit a level of resistance, and then boom, the next leg down. And then it rallies up again, goes down again, rallies up, goes down again. This is because of investor psychology. So when it drops, people are panicking. Oh my God! And when people panic, that's when they sell. So most people sell at the worst possible time. Never sell in a panic. Wait for the rally when people are getting some hope back. Oh, it's going up, it's going up. So when everyone is hoping, what do? That's right, you sell your stocks before it collapses again. So take a look, for example, during the financial crisis. You can see that the bear market lasted for 1.5 years. But again, the price of the S&P did not go down in a straight line. It went down, right? And then it rallied up, and then went down again, rallied up, went down again, so on and so forth. So these green arrows are what we call the relief rallies, okay? So you always want to wait for the relief rally, for the market to go up to a level of resistance, and then you get out of the market before it collapses again, all right? There you go. So never sell at the low, because once you sell, you're going to see it go up again. Sell at the high. Really simple. Now, I know some people are wondering, even if I hold good companies, could I sell them right now and buy them back lower? Yeah, you could do that, right? But to do that, you have to be really good at looking at technical analysis, reading the chart patterns, looking at moving averages. So, for example, that's one of the things I do sometimes. So if you look at, for example, the S&P ETF, you can see that over here, it went into a bear market with the moving averages crossing down. So the moment, for example, the 50 moving average crosses below the 150 moving average, we could actually sell to raise cash. And we get back in only when the 50 moving average crosses back above the 150 moving average, signaling the new uptrend. We get in at the start of the new uptrend. So we avoid a lot of those downtrend periods. Sure, you could do that. But the trouble is, this protracted bear markets only happen once in 20 years, right? Most of the time, bear markets don't last that long. They last for 1, 3, 4 months. So in those instances, the danger is if you sell, by the time it reverses back up, you may have to get back in at a higher price. So for example, if you look at the last 2018 bear market, that only lasted 3 months. So over here, you can see the uptrend. When it reversed into a downtrend and the moving averages cross and you sold there, right? Sure, it went down, but it quickly reversed back up and it started the new uptrend. When the moving averages cross, you would have gotten back in at a higher price. So that's the risk of getting out and attempting to get back in. You may have to pay a higher price. Or worse, if you do not monitor the markets close enough and you miss out on getting back in, by the time you look at it, it may be at all-time highs, and you would have missed a big chunk of your portfolio's returns over time. Right, next question. Should I buy stocks in a bear market or wait for the bull market to buy stocks? Sure, you can always wait for the bull market, but again, by then, prices will be a lot higher, right? So the answer is yes, I do buy stocks in a bear market, but I only buy, again, high-quality stocks. I keep talking about this all the time. Companies that have wide economic moats, consistent sales and profits, conservative debt, and they're undervalued. And if you watch my earlier video, the best kind of stocks to buy are businesses whose sales and profits are not affected by a recession. They are recession proof and they're coronavirus proof. So think about it. If people are quarantined and they have to stay at home for the next 2 years and they can't go out for 2 years, which businesses will still be able to do well? All right. What are the things that you got to spend on even though you're at home? You got to go on Google, right? You got to search on Google. You got to watch videos on YouTube, which again is owned by Google. Okay. You got to use WhatsApp. You got to use Facebook, Instagram. These are all owned by Facebook. You got to work from home. Use video conferencing like Skype or like Zoom communications. You got to use software from Adobe or Microsoft. So these are the virus-proof stocks that I will keep buying in a recession. Why? Because their profits will not really be affected. They're going down purely for emotional reasons because people are panicking. And the moment people stop panicking and confidence comes back, these stocks will be marked up 2 to 3 times higher. You're going to make a fortune, right? So like I said, focus on defensive and secular growth stocks. The other thing is this. I don't buy stocks when they are falling like a knife. You buy them when they're at support levels in a consolidation or on an uptrend. So you got to look at the technical analysis to know the best times to accumulate shares. So for example, look at Unilever. This is known as a defensive company, a recession-proof company. But the price still comes down temporarily because of widespread panic and fear in the markets, right? And over here you can see that this is known as a resistance level that has become a support level. So the moment the price falls to a support level, it bounces up. That's when I will add shares at strong support levels. Okay, so if you're in my Ultimate Investors Playbook, which is the subscription service I have, where people get to mirror my portfolio, they get to see what I'm buying and selling every single day. You get an immediate alert when I'm entering the market. So for example, this is our Telegram chat group, and that's me on the 13th of March. Just added Unilever at 49.17 as it bounced off strong support on weekly and monthly candles. And this stock is one that's relatively, pardon the spelling error, typing too fast, recession proof. All right. You know what's the best thing about having this private investment community? I've got students from all around the world, from different professions, that add tremendous value to our community. For example, one of my students, Kadar, he's a medical scientist, and he talks to other scientists around the world who are racing for a vaccine and a cure, and he's always updating us on the latest developments. For example, he said over here, okay guys, this is big. Once other scientists verify this claim and it holds true, it means that we'll get a treatment in a very short period of time. And he quotes a lot of these medical sites. So really useful. We'll be the first to know once they've got a vaccine and a cure, and the moment the news is released, the market is going to go to all-time highs. And we'll be the first to get in because of all this information that we get from students from all around the world. So remember, this bear market will not last for long. Winter doesn't last forever. It will end eventually. And when it ends, it will sow the seeds for the next bull market. And it's the decisions and actions you take during the bear market that's going to set you up to make your fortune when the bull market happens, not the decisions you make when the bull market happens. So the most important thing for you to do right now is to manage your psychology. And that's the difference between the typical retail investor and the professional experienced investor. The typical investor hates volatility, and when they see prices going down, they feel really bad about it. They panic, they get scared, and they sell, and they never get back into the market, and they will end up losing a lot of money because of the bear markets. But as experienced investors, we think differently, we feel differently. Why? Because we know that the stocks of the companies we buy are still the same companies from where they were 2 months ago. I mean, think about it, right? I mean, I own Microsoft. Microsoft is the same business it was 1 month ago. It's still selling software. People are still paying subscription to Microsoft. McDonald's is still selling hamburgers. Nothing has changed. The businesses have not changed. The only thing that has changed are the prices being quoted by Mr. Market, who's an alcoholic, manic depressive, right, who's short-sighted. So just because Mr. Market quotes a ridiculous price doesn't mean you should entertain him or be guided by him. Instead, you should take advantage of Mr. Market and buy shares from him at a crazy price while he's freaking out. Now, in order to have the confidence in a business, you got to know how to value a business. So for example, McDonald's is one of my core holdings, and I love McDonald's. I go there every single week. McDonald's is still the same business it was a month ago. It's still selling burgers, right? And if you take a look at the intrinsic value of McDonald's, and we use this intrinsic value calculator that we use in all our programs, okay, you can see that McDonald's is worth about roughly $210. That's the intrinsic value based on its assets, its debt, its cash flow. But currently, because of the panic, the price is now selling at $177. It's below the intrinsic value. See, over time, businesses rise in value, and it's reflected by this dotted line. This dotted line represents the true value of the company. But the price of the shares do not go up in a straight line, right? So again, they go up and down based on emotions. When people are excited, they go, yes, all right, and they quote a high price. And when they get fearful, oh my God, and they quote a low price, right? That's Mr. Market. Mr. Market is a manic depressive. He's nuts, all right? So when Mr. Market is like, all right, things are going great, optimistic, you don't want to buy from Mr. Market, right? You want to sell him your shares at a crazy high price. But now that Mr. Market's freaking out and he's like dumping everything, that's when you want to buy it. Because eventually it's going to go to all-time highs again. That's right. All right, so let me summarize the 4 steps that you can take right now to manage your portfolio to protect it during the bear market, at the same time to set yourself up to make huge returns when the bull market comes. Okay, so number 1 is to ensure your portfolio is well diversified into really good companies. So you only want good companies in your portfolio. Get rid of the lousy companies. And again, with those companies in your portfolio, you want them to be recession-proof and coronavirus-proof stocks as far as possible, and have a good mix of companies in your portfolio. So for example, in my portfolio, I've got a good mix between US stocks and China stocks. And it's really helpful right now, because right now, as the US market is going down, China's stock market has begun to stabilize, because as US is shutting down and quarantining its people, China is now going back to normal. So it's always good to diversify between different markets. The next thing is to diversify between different kinds of stocks. So I don't just hold cyclical stocks in my portfolio. So again, cyclical stocks are like banks and real estate and industrial stocks. So I've only got, in fact, 13% of cyclical stocks that make up my portfolio, because these are more volatile. But you can see that 22% of my portfolio are defensive companies, like, again, Procter & Gamble and Unilever and McDonald's. These are recession-proof companies. And 24% of my stocks are growth companies, secular growth companies that will grow regardless of a recession. Your Amazon, your Alibaba, your Tencent, your Microsoft, and Apple, right? I also have got a good amount of ETFs where they invest in a broad spectrum of companies that track the index. Number 2, start to take this opportunity to look for great companies that are selling at bargain basement prices, and start to save up some money by spending less than you earn, save up some of your disposable income, and start buying shares of these great companies at support levels. And again, do join us in the Ultimate Investors Playbook, which is a subscription service where you can see how I manage my portfolio, and you can make great decisions based on that. And you also get all my alerts via Telegram and email as well. Number 3, very important, learn to profit from the short-term fall in stock prices using options. Now, I know that in the long run, the stock market will always go higher. Good companies will always go higher. But in the short term, stock prices can still go down for a few months, another 10 or 20%. So instead of sucking my thumb and not doing anything, it's good that I can make money as the market goes down. So how do I make money as the market goes down? I short the market. And I short the market using what is known as put options. Put options are kind of like an insurance contract that you buy. So it's kind of like you have a house, and if you see the fire is coming to the house, what do? You buy fire insurance. You pay a premium so that if the fire burns your house down, what happens? You don't lose money. The insurance company will pay you for the damage. Now you can do the same thing in the stock market using put options. So put options are like insurance. When I buy insurance, what happens? I'm okay if the market collapses in the short term because I'm getting lots of profits from my put option contracts. And my students in my options class, they are really happy because they're making money as the market's going down. So this is our options chat group over here, Options Iron Striker. And you can see one of my students, in fact, it's from Vietnam. He says, just closed my SPY bear put spread with 274% profit. When I entered on 3rd of March, my plan was to cut loss. Many thanks, Adam and Pham Van, who is one of my other trainers, right? This is one of my screenshots from my put contracts on the S&P 500 futures. And you can see that as the market went down, I made $7,500, which I've already taken profit on, okay? This is another, some more messages from my students, again from my playbook. This is from George. He says, taking options lessons to hedge my investment was a good decision. I can sleep tight and make money while the markets go down. All right, so you have to make money regardless whether the market goes up or goes down, okay? This is from the Whale Investor course. Me too. This is Michael. I discovered Adam on YouTube and knew I had to have him as my mentor. I bought all the courses where I learned swing trading, investment, options, and Forex earlier this month. Even though the market is going down, my account is staying the same because of hedging. I'm not worried about the market falling when I'm sleeping, right? So really useful to learn options to protect yourself and profit as the market collapses. This is one of my other accounts on Interactive Brokers. You can see the last few days as the market going down, I was again using put options on the S&P futures and made 15,000 US dollars, which I took profit on just last Friday. And you also will learn how to sell covered call options every month to generate extra income from your investment positions. And by doing this, I'm able to get roughly 2 to 3% return a month. May not seem like a lot, but 2 to 3% return is about 24 to 30% return a year as the stocks are going down by selling call options. Like this one is an Apple call option I sold and I made $300. All right, United Health selling the call option and I made $500. So I'm making money as the market is going sideways or going down. So these are all the things that you can do to really protect your portfolio and generate income every month in a bear market. At the same time, set yourself up to make huge profits when the bull market comes, and it will come sooner than you think.